This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the podcast, I have John Bollinger, the John Bollinger of Bollinger Band fame. One of the technical indicators that just about everyone has heard of or known about, even if they don't know much about it. John has been popularizing price-based indicators, often with his name, since the early 1980s. I look forward to this conversation, and I hope you enjoy. Yes, this is Mike Covel. I'm supposed to be speaking with John this morning for an interview.
This is he.
Hey, John. Mike Covel, how are you?
I'm well, and yourself?
I'm not too bad.
Having walked in the same circles for many years, I don't believe we've actually ever met.
No, I don't think so. And I'm actually surprised at my inattentiveness to miss out and do a bunch of podcast episodes and not ask you already to begin with. So
No problem.
I saw you come up on Facebook and I was like, oh my gosh, hold on. We're connecting on Facebook. What's going on here? Why have I not asked John?
I don't know. You said something interesting, I think.
What did I say?
I forget. You posted something, and I thought it was interesting, so I responded to it. I can't remember exactly what it was.
Well, listen, I want you to define, if you can for me, and I know you can, I want to, and pretend this is a non-technical audience, but just give the classic Bollinger, and I'm going to get back into the details. I want to kind of know how this all unfolded, but the classic Bollinger Band indicator, and describe it, if you can, for the layperson and even for the intermediate understanding. Just what is a Bollinger Band indicator for folks out there?
So, Bollinger Bands is simply a kind of trading band, and all trading bands serve the same purpose. They define whether price is high or low on a relative basis. By definition, price is high at the upper trading band. By definition, price is low at the lower trading band. And traders can use that information to make rigorous trading decisions, to take the emotions out of the trading process. Bollinger Bands use volatility to determine the width of the bands. So that means they're highly adaptive to changing market conditions. When the market's quiet, the bands will be quite tight, and so the definition of relatively high or relatively low will be quite close to the current price structure. When there's a lot of volatility and the market's trending very strongly, the definition will expand dramatically, and it will keep our definition of relatively high and relatively low germane to the price structure. And the sort of magic mechanism in there is a volatility calculation called standard deviation. If you were to look inside the math of standard deviation, you would see that there's a mathematical process called squaring. And it takes the small deviations from the average and squares them. That's the key mechanism of standard deviation. When price is close to the moving average, the deviations are small, and the measure of standard deviation is very small. But as price starts to move away from the average and the deviations get larger, that mechanism is working away in there, and it's squaring those larger deviations. Now, if you square a small number like 2, you get a slightly larger number like 4. But if you square a larger number like 10, you get a much larger number like 100. And it's that squaring that makes the bands so responsive to changes in the price structure. And that's sort of the magic behind Bollinger Bands.
John, when is the first date that you put the Bollinger Band, the original concept? I know there's been different versions and iterations over the years, but the very first time, early 80s, 1980, 1982, when did you put it out?
The very first version of Bollinger Bands, probably 1982. As you point out, it was an evolutionary process. I had one of the early microcomputers, and this was in the days before PCs, when, you know, if you wanted a small computer, you sort of had to build it yourself. You assembled it out of boards that you would buy from various hobbyist shops. And I had one of those, and I was an active options trader. So, as you know, if you're going to be an options trader, you have to have a handle on volatility estimates. That's the essence of the business. And in those days, we had a lot of sort of very quick volatility estimating ideas. You know, half the prior, the immediately prior range, or we had a lot of sort of rules of thumb. But I wanted to do a little bit better. And since I had this computer and one of the very early spreadsheet programs, it was called SuperCalc, I started calculating volatility before each of the trades that I would make, so I could get a good handle on what was going on. One day, I calculated volatility, and I copied the formula down a row of cells. And I saw that volatility was changing. Now, you know, that doesn't seem like something, you know, very interesting today, because we all know that volatility is volatile and it changes over time. But back in the 80s, we didn't know that. We thought that volatility was a stable quantity, like a property of a stock. Like we said that IBM's beta was 1.2, and you know, we just didn't believe that volatility was a dynamic quantity. Now, to give you a little bit of reason why I thought that might be so important, I was trading at the time using trading bands, and we're trading a very, very simple but very effective system at the time. It used the Dow Jones Industrial Average and percentage bands, 4.5% above and below a 21-day moving average. And we would compare price action inside those bands to the action of a couple of oscillators, an advanced decline oscillator and an up and down volume oscillator. And it was really a good technique at the time. It had very good risk-reward ratio, nice percentage of winning trades versus losing trades. Good system stats, although we didn't even know they were system stats in those days. But the problem is that as the market changed, you would have to change the width of the bands. And, you know, sometimes 4% bands would work, sometimes 5, 6, 7% bands. And if you traded stocks instead of the Dow or something like that, then you'd have to constantly be calculating the bands and trying to figure out how wide to make the bands. And we did this by using a tissue overlay on a chart. We would, you know, draw a chart, and then we'd take a piece of tissue and trace the moving average and slide it up the piece of paper so that it would touch all the highs, and slide it down the piece of paper so it would touch all the lows, and then figure out what the best bandwidth at that time was. The problem with that is that you let emotions into the trading process. If you're bullish, you set the bands to present the bullish picture, and if you were bearish, you set the bands to present a bearish picture. So I was looking for a way to automate the changing of the bandwidth. And when I saw that calculation for volatility changing over time, I went, wow.
Light bulb moment.
Light bulb moment. And that was probably in the middle of 1982, maybe a little earlier. It took me a little while to sort out the details, but very shortly thereafter, Bollinger Bands, as we know them today, were born.
let me get you to get into a little philosophy of you, because I want to understand what you were thinking, what was driving you, where was the creativity coming from? I saw in your background, which kind of surprised me. I did not know, and I just doing a little homework today, I saw that your college education was not finance, was not trading. You came at it from a completely different perspective. And you might want to talk about that for a moment, but I'm curious as to what you think might have been some of your curiosity triggers. Why were you digging? I mean, a lot of other people just accepted things. So why were you innovating? What was going on in your head?
It's true. I didn't go to a university. I went to an art school, the School of Visual Arts in New York, and I studied cinema, specifically cinematography, although there was only a single course at that time. The film school there was relatively new. I had become interested in light some years earlier and had kind of studied the properties of light and the way light combines and affects people and emotions and such like that. And I had worked in various media type jobs and such, and I got more and more fascinated by film itself. But light was my introduction to film, and then I got just fascinated by the sorts of things that you could do with film. And rather than become a traditional, cameraman, I became the sort of guy who worked in special effects photography. I wanted to do like movie magic. Of course, my entire skill set has been obsoleted today by a process we call computer graphics. But in those days, you did most of that in the camera. And I was really interested in, the ways that you could fool the eye with the camera. So I had a career of 10 years or so in the movie business, most of which was spent with, focused on high speed and special effects photography and such like that. So I guess I brought that, a similar approach to the markets as I made a long transition from the very late 70s into the very early 80s from the business of cinema to the business of trading. I'd always been interested in markets, and I just got more and more interested. Part of the puzzle was that computer I told you about a little earlier. I had actually bought that and put that together when I was still in the film business. A partner and I owned a grip truck, which is one of those trucks you see parked at every movie location, tractor trailer with about 60,000 items on it. And we were trying to keep track of the inventory. As you can imagine, it could be a problem. So we bought this early microcomputer and a copy of D-Base 2, one of the first database products, to try to keep track of the inventory. And at the time, I was getting more and more interested in the market. I kept looking at the computer and kept thinking there must be some way that computer can help me in the market. I started out doing fundamental analysis like everybody does and got quickly disappointed like many do, and was looking around. I heard about technical analysis. I read Schaubacker, and I read Martin Pring's first book. I read Edwards and McGee and Robert Ray, the Dow Theory, and the more I read, the more this sort of stuff appealed to me. And in those days, it was actually very hard to get your hands on any information about this. So there was a bit of a chase about the entire process. It was really hard to learn this stuff. You had to find people. And finally, I found a trader, and I apprenticed to him for a year. for no wage whatsoever. I kept his charts in real time for him for a year and learned technical analysis that way. That was kind of how you had to do it in those days. There was no internet and, none of this widely available information that young trader can get now. So,
but I think that attitude, though, that curiosity attitude, the desire to be an apprentice, I sometimes wonder today if young people still realize that the game of life, the game of success, is still taking those chances. And so I think some people get so preoccupied with like, well, what's my salary? What's my salary? And here you're saying you're one of the guys that one of the most successful careers in this space, and you're like, hey, hold on, I worked for a year for free. I just want it to be close to the action. I just want it to learn.
Yeah. Well, and actually, I think a large portion of that is still alive. You go into any college these days, any university these days, and these kids are taking a lot of internships, and they're unpaid internships. And some of those kids, not all of them, but some of the kids actually have the right idea. They're looking to, really learn and sponge up and grow in a real world environment. They realize that, the education they're getting in college is just that, an education, and they need some real world experience if they're going to do something out there. So I'm not certain that sort of idea is dead. And, another great example, all the startups you keep on seeing popping up out of Silicon Valley in the tech world. I think a lot of people are really willing to take some chances and try to do something great, whether it's just something great on a small level for themselves or maybe perhaps something great in relation to the world.
I've had a ton of questions here that I want to ask, and what's so cool is you've been answering most of them before I ask. But I saw one comment from you, and I think it's a great, simple thought, where you said the best authority is the price itself. And I'm curious, as you look back on your career so far, and obviously you're still, knee deep in the middle of this business, the best authority is the price itself. How accepted do you think that simple comment with quite a bit of depth behind it, how accepted do you think that statement really is in the world of markets and market players?
Not very well accepted at all, I don't think. I think a lot of people are grumpy about that idea. Take, for example, the idea of the fundamental analyst. The difference between a fundamental analyst and a technical analyst is quite simple. The fundamental analyst goes and examines the company's books and, the macroeconomic environment and competition factors and such like that, and comes up with a valuation for the company. Figures out what the float is and comes up with a theoretical price that for the share that he thinks what the share is worth, say $50. And he goes out there in the market, and if the share is trading at $70, then he sells it. And if it's trading at $30, he buys it. Just as simple as that. But there's something behind that. What he's saying is that he knows better than the market. All right? He says that his estimate is correct, and he goes out to try to find out if the market is incorrect and take advantage of that. The technician does exactly the opposite. The technician studies price because the technician believes, or whether consciously or not, the technician believes that all the information in the system has been pulled into price. And by studying price, you can learn the most about a security. So they're just sort of opposing philosophies of how you approach markets. I believe in markets. Fundamental analysts believe in analysis.
I think sometimes too, price, describing it as you did, the best authority is the price itself, is a great way to describe it. But I think sometimes we all forget what price is. So maybe some critics might come out about technical analysis and they want to get into this and that. But the reality is the price is just representative of what the people are voting with their dollars for. I mean, it's just the people, it's the crowd. Isn't it the most direct representation of the crowd?
It is the most direct representation of the crowd, and it is also the price that you may transact at.
Yeah, it's like it's cutting to the chase,
So you may believe that what you're buying is worth something more or less than what you're buying, but the fact is that the market has set the price, and you'd better pay attention.
Let me shift gears on you a second. You've one of the few that, I mean, you've a lot of TV time. So, the big shows over the years have always wanted to have John Bollinger on. But I almost wonder how many of them really, you get your time to say what you want to say, but I don't know the acceptance. How do you see that? And you've been involved in the media so much in presenting your views and working in these environments. Is it somewhat like, you do your thing and then they go right back to 99% the fundamentals? How do you look at media and you presenting your messages over the years?
I think that the acceptance of markets and the acceptance of the price discovery mechanism, the acceptance of technical analysis or quantitative analysis has grown steadily over the years, and to the point where I think that there are probably more people paying attention to price than not. If you look out there in the literature and such like, you don't see that much new emerging in the fundamental analysis world. But if you look at the literature of quantitative analysis, or you look at the literature of behavioral finance, you see lots of new ideas coming up and lots of new methods and ways of approaching the markets being discussed. So I think that's sort of the most valid measure to see, where people are willing to put their time and effort into the process. And, if I were starting out now, I doubt that I would be known as a technician. I'm almost certain that I would be known as a quantitative analyst if I were starting out now.
Yeah, it's interesting you say that. I think that is a distinction. I think the word technical analyst and technician does seem to be morphing more towards the quant description.
I think it's true. The interesting thing is that the literature of technical analysis, and it's a deep and wide literature going back, well more than 100 years, is full of great ideas. And you can go back and read the old books. Not too many people bother to do that these days. I have a large library myself that I've accumulated over the years. But you can go back and sort through the old literature. And those guys really understood markets.
They were fabulous. They were some of the books from the 30s, 40s, 50s, fabulous.
Yeah, so you can open up almost any of those and pick out 3 or 4 good ideas, sit down with somebody who's quantitatively oriented and say, well, look, can we build some rigorous approaches based on these ideas? And you'll find that you have all sorts of interesting ways to go.
Hey, John, I got to let you run, but I want to ask you one more question and let you tell the audience where they can find out more about you. But what are you working on these days that excite you? What when you get, because I can hear it in your voice, I can hear the passion. So what makes you get up every day? What are you most excited about these days?
I hate to say it, but I'm really on the same track from 30 years ago. I think that volatility is the most important, least analyzed, and worst understood aspect of the market. And I spend my time thinking about volatility and ways that it can be used in the trading process, its properties. I especially like to think about how the ways in which volatility is misunderstood, especially by academics, and because that creates huge opportunity. So for me, the name of the game is the same as it was when I was an options trader, 35 years ago. Volatility is the key.
Yeah, I remember when I first saw volatility used in position sizing algorithms, and I had those light bulb moments. You're like, okay.
Now there's something, that, okay, you want advice for people? There it is. You just said it. Position sizing. This is the least understood and most important aspect of the trading process. It is almost nobody spends any time on it, and, everybody ought to spend lots of time on it. The size of the position can sink your operation or take you over the top for the same trading system. The same set of trades, you just vary the position size, and all of a sudden you turn a fabulous system into a disaster. So for me, if I had to suggest, an approach to anybody, I would say study position sizing. I think that's where the next really big innovations are going to come from.
Hey, John, I appreciate the wisdom today, and I enjoy the conversation. Hopefully we can catch up in person one day. And you're in Southern California today, I expect, yes?
Yeah, it's a little foggy this morning, but we're hoping for a nice day.
Hey, John, look, take care. I appreciate you taking the time today.
My pleasure entirely. Thanks for having the chat with me.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.